Gold and silver just pulled off a fake out, and inside that fake out sits both a real risk and a real opportunity for anybody stacking in 2026. That's what I want to walk you through today, plain and simple, because I've been watching this metal move for a long time, and what's happening right now is the kind of thing that separates the folks who act from the folks who spend the next 2 years kicking themselves. There's a move underway, some sharp people are calling it a trick, and I want you to understand what's actually going on underneath it so you can decide for yourself. Let me set the table with where we sit as I'm talking to you. Gold is running around $4,376 an ounce. That's roughly 10% off the lows it made back in July, and it's pulled back from an all-time high above $5,000 that it set in February of this year. Silver is sitting near $66 an ounce. So both metals had a wild run up, then a pullback, and now gold has turned back higher and pushed up about 10% off last month's bottom. Hold on to those numbers because the whole story I'm about to tell you hangs off them. Now here's the part that has people arguing. Gold just broke through a long downward resistance line, a line that's been pressing down on the price for a good while, and it did it with some force. When a chart does that, some analysts get excited and some get suspicious. The suspicious ones are warning that this could be a fake out to the upside, a false break that sucks in buyers right before the price rolls over and heads lower again. And I'll be straight with you, that can happen. Markets do lie to you sometimes. A break higher can turn out to be bait, dragging in the eager money right at the top, so the big players have somebody to sell to. So I don't blame anyone for being careful. But here's where I part ways with the doom crowd, because this move isn't magic and it isn't astrology for men. There are real, measurable forces pushing this metal, and once you see them, you stop worrying about whether the chart is playing a trick and you start paying attention to what the whole world is telling you. A line on a screen is just a line. The reason it broke is what counts, and the reasons are stacking up on the table right in front of us. I'm Hank, and I've stacked physical silver and gold for 35 years through every boom and bust, so if you want to stack the smart way, consider subscribing. It's free, and you can always change your mind later. So let me show you the level that matters most, and then the forces driving the whole thing. The number I want you watching is right around $4,500 an ounce on gold. That's not a level I picked out of thin air. That's where gold's 200-day moving average and that long downward resistance line are crossing, right about the same spot. When you get two important lines meeting in one place like that, the market treats it as a wall. Penetrating that wall convincingly, closing above it and staying there, would be a very significant sign. And here's the flip side that matters just as much for a buyer. If gold pulls back down toward that line, toward that 4,500 area, those pullbacks may be among the last buying chances you get at these kinds of levels before the thing breaks out for real. This looks a whole lot like a large bull flag pattern, the kind of long pause a market takes before its next big leg up. A bull flag is just a fancy name for a market catching its breath. It runs hard, then it drifts sideways and downward for a spell, while everybody argues about whether the party's over, and then it takes off again in the same direction it was already going. That's what a healthy pullback toward the line would be, a chance to catch your breath and back up the truck before the next leg. I've seen this movie before. It looked a lot like 2008, right before the big run that followed. The folks who stepped in during that quiet, nervous stretch, when everyone else was sure the top was in, are the ones who came out the other side very glad they did. So let me lay out the forces, because this is what the chart doubters keep leaving out. Start with the Middle East. Tension over there keeps dragging on markets, and it keeps feeding into inflation, because when that part of the world gets shaky, energy and shipping and nerves all get more expensive. That's one hand on the scale. Then look at the stock market itself. Valuations are stretched about as tight as I've ever seen them, and there's this circular trade going on in the artificial intelligence names, where the same handful of companies are buying from each other and propping each other up, creating a kind of frothiness at the top. That froth makes serious investors nervous. They can feel that something dramatic could happen, and when smart money gets nervous, it starts looking for the exits and for somewhere safe to hide. That brings me to a piece of history worth remembering, and it's the 1987 crash. What happened then was margin calls. Folks were borrowed up to their eyeballs, the market cracked, and everybody had to sell everything at once to cover their loans. And here's the thing people forget. When that kind of sudden collapse hits, metals get knocked down too for a minute, because the panic sellers grab whatever they can to raise cash, and gold and silver are easy to sell. But that dip is brief. Right after, the metals run like a rocket because all that scared capital comes pouring into safe assets. We watched it happen in 2008. Metals took a hit in the first wave, then turned around and led the recovery. So if you see the metals dip in a panic, don't let it shake you. That's the setup, not the ending. I'd go further and say that a sharp, scary drop like that is often the single best gift the market ever hands a patient stacker. The trouble is, it never feels like a gift in the moment. In the moment it feels like the world's ending and you were a fool to buy metal in the first place. That's exactly the feeling you have to be ready to ignore, because the people who buy when it's terrifying are the people who own real ounces when the rocket lights. Now let me give you a reality check on inflation, because the official story doesn't hold up. The people in charge keep telling us we're in a disinflation, that price increases are cooling off and everything's under control. I don't buy it, and neither should you, because you live in the real world where you actually pay for things. Look at what's happened to everyday prices over roughly the last 7 years. Used cars are up about 29%. New cars up around 22%. Groceries up about 33%. Family health insurance up around 38%. Eating at a restaurant costs about 39% more. Gasoline is up around 43%. Home prices up about 60%. Your utility bills up around 62%. A dozen eggs up about 76%. Ground beef up around 81%. And coffee. Coffee is up about 123%. Now you tell me, does that sound like a low inflation world to you? That's not disinflation. That's the steady grinding down of what your dollar can buy, and it's the strongest argument I know for owning something they can't print. Which takes me straight to the debt, because that's the engine behind all of it. The United States is right up against $40 trillion in debt. As I'm talking to you, we're sitting near $39.8 trillion, and we cross the 40 trillion mark by the end of this month. Let that sink in. The net interest on that debt is now running over $1 trillion a year, and about a third of everything the federal government spends is going just to pay interest. Not roads, not defense, not anything you can point to, just interest on money already spent. And the debt is now sitting around 123 to 125% of the entire economy, more than the country produces in a year. Here's the simple truth about a hole that deep: they are not going to default. A country that borrows in its own currency doesn't have to. What it does instead is print. It creates the money to pay what it owes, and printing money, friend, is the loudest call there is for physical hard assets. When the dollar in your pocket is being multiplied by folks in a marble building, the way you protect yourself is by owning things that can't be multiplied. Nobody can print an ounce of gold. Nobody can conjure another ounce of silver out of a keyboard. It has to be dug out of the ground with real sweat and real cost, and that's the whole point. That's what makes it honest money when the paper kind is getting less honest by the year. The debt doesn't get paid back in the way you or I pay back a loan. It gets inflated away, a little at a time, and every dollar of that inflation is a dollar slipping right out of your savings and showing up in the price of an ounce. Now here's something a lot of stackers get wrong, and it's important. People assume gold and silver only go up when everything else goes up. That's not true. Metals can move inverse to stocks. Look back at early 2025, February through April, when the S&P fell and the metals bucked the trend and held their ground and climbed. That tells you something. It tells you the metals may have already priced in the trouble that's coming, and they could go on to make brand new highs even while the stock market is making new lows, and I've watched it firsthand lately. On the down days for stocks recently, the metals complex has been rising. That's the market whispering to you about where the safe money wants to go. So step back and ask the real question. If capital is getting nervous, where else does it go? Because money has to sit somewhere. Look at bonds. Long-term bonds are being shunned right now. The demand for the 30-year is weak, and yields are pushing up, which is the market's way of saying nobody wants to lend to the government for 30 years without getting paid a lot more for the risk. So bonds are out of favor. What about just leaving it in the bank? Well, when you park your money in a bank in a world with real inflation, you are guaranteeing yourself a loss of somewhere between 2 and 7% a year in what that money can actually buy. You're paying for the privilege of watching your purchasing power melt. And here's a fact that ought to stick with you. When the smart folks build an optimized portfolio, the kind meant to survive whatever comes, gold and silver still show up at around 20% of the whole thing. 20%. That's not a fringe bet, that's a cornerstone. Think about what that says. Even the buttoned-up money managers, the ones who wear the suits and run the numbers all day, land on a full fifth of the portfolio in metal when they let the math do the talking. If that's where the careful, cautious folks end up, then a working man protecting his family has no business owning zero. Somewhere between a fifth of your wealth and none at all is the honest answer for most people, and none at all is the one place you don't want to be standing when the music stops. Now I want to tell you about the piece that most people have never heard of, and it might be the most important part of this whole story. It's Japan, and what's called the yen carry trade. Japan is the largest foreign owner of United States debt. They hold well over $1 trillion in our treasuries. For decades, Japan has been the source of cheap money for the whole world, because you could borrow yen for almost nothing and put it to work anywhere. But that arrangement is coming under strain. The United States Treasury, under Scott Bessent, has been working with Japan to prop up the yen and keep them from dumping our treasuries into a bond market that's already weak. Think about how strange that is. They've drawn a line in the sand near 160 yen to the dollar. After they step in and intervene, it drops back toward 155, and then it creeps right back toward 160 again. They keep having to defend that line. Here's why that matters to you and your stack. Those days of Japan being the endless source of cheap capital are ending. For a generation, cheap Japanese money was like a quiet river running underneath the whole world's finances, and hardly anybody thought about it because it just kept flowing. Well, the river is running dry. The cycles are turning faster than they used to. Japan is in real trouble, and they may have to start selling our treasuries within a year to take care of their own house. And think about what that means. If the largest foreign holder of American debt turns from a buyer into a seller, that's a whole lot of paper hitting a market that's already got weak demand. Somebody has to step in and buy it, and the only somebody big enough is the printing press. And when that safe trade shifts, when the money that's been sitting quiet over there starts to move, you should expect a significant move in world stock markets and in gold and silver. And it's likely to come faster than anyone anticipates, because these markets are so big and so liquid that they can crack in the blink of an eye. The very thing that makes them feel safe, all that easy buying and selling, is what lets them come apart in a hurry when the mood turns. Let me pull the camera back even further, because there's a bigger shift underneath all of this. For a long time now, the safe haven currencies of the world have been three: the yen, the dollar, and the Swiss franc. Those were the places money ran to when it got scared. But look at the picture we're in now. The most indebted country on earth, which is Japan, is having to be propped up by the country with the largest nominal debt on earth, which is the United States. When your safe havens are leaning on each other to stay standing, that tells you something about how shaky the whole fiat system has gotten. Now, I'm not standing here telling you it all falls apart tomorrow. It doesn't mean the system fails next week. But it does mean that not owning any gold and silver in a setup like this is almost a game of financial Russian roulette. You're betting nothing goes wrong when everything is telling you the odds have shifted. Think about capital as a zero-sum game, because that's what it is. The money has to go somewhere. It can't just vanish, and right now it's already speaking. It's already demanding to be paid more to sit in the United States, in Japan, and in Switzerland. That's what rising yields are, the market charging a higher price for the risk, and eventually the party that has to pay all that interest can't turn a profit anymore, and that's the doorway into stagflation or something worse, where growth stalls and prices keep climbing at the same time. You can see the repricing happening around the edges already. Deutsche Bank in Europe is facilitating settlement in Chinese yuan. Africa is building out a gold market exchange of its own. The BRICS nations keep working to de-emphasize the dollar in their trade. Now I'll be honest with you about my read on that, and it's a measured one. I think the dollar likely stays fairly dominant in the near term. It's not getting knocked off its throne this year. But capital is already repricing American risk right now in real time, and that repricing is exactly what's lighting a fire under gold and silver. So let me bring this all the way home, because at the end of the day, the roadmap matters. The bigger picture points to a cycle top, possibly by 2028, and the targets along the way are worth holding in your mind. A minimum around $6,000 an ounce on gold, and likely $7,500, which is the second goal after that first $5,000 level got taken out. And with a 40-to-1 gold to silver ratio, which is a normal historical relationship, that implies silver at a minimum of $150 an ounce and possibly $200. Sit with those numbers a second. From $66 silver, we're talking about a move that could more than double it and then some. That's not a fantasy. That's what the math says if these forces play out the way they've played out before. Now I know exactly what some of you are thinking, because I've heard it 1,000 times. You're thinking you'll wait for the price to come back down, wait for the perfect entry, wait for the big flush out where everybody panics and you swoop in and buy the bottom. And I want to talk you out of that because it's the single biggest mistake I watch people make. Plenty of folks understand exactly why to own gold and silver. They can recite every reason I just gave you, but they never actually participate because they're forever waiting for a better price that never comes. Let me give you the example that ought to settle it. Back in early 2024, when gold broke out, a whole lot of people said they'd buy it when it dropped back to $2,000. They were sure it'd come back. It never did. It kept climbing, and those same folks ended up buying anyway, later, at $3,500 and $4,000. They waited themselves right out of the best prices they were ever going to see. And I promise you, standing here today, there are folks watching $66 silver and $4,000 gold and telling themselves the very same thing, that they'll get in when it comes back down. Some of them will still be saying it when silver's at 150. Waiting feels smart in the moment, but more often than not, it's just fear wearing a clever disguise. So don't be that person. Don't wait for the perfect price, and don't wait for the flush out that may never come the way you imagine it. The play here isn't to time the exact bottom. Nobody rings a bell at the bottom. The play is to stay on your plan. Dollar cost average, which just means buying a steady amount on a regular schedule so you catch a fair average price over time. Size it correctly in your portfolio so it's meaningful but it isn't everything, and then take action, actually do it, instead of talking about it. Because here's the whole thing in one breath. We've got a metal that just broke a long resistance line and ran 10% off its lows. We've got a key level near 4,500 that could be your last good buying zone before the breakout. We've got 40 trillion in debt and a third of the budget going to interest, real inflation grinding on everything you buy, bonds getting shunned, and the safe haven currencies of the world leaning on each other to stay upright. The fake out is the risk. The forces underneath it are the opportunity, and the only way to lose from here is to stand on the sidelines waiting for a moment that already passed you by. Stay on the plan, keep stacking, and let the big picture forces do the heavy lifting. The metal's been good to patient people for a very long time, and I don't expect that to change now. Take care of yourself and take care of your